In this video, we're going to be looking at governance-based investing and how you can profit from looking at corporate governance and knowing good from bad, right from wrong. Okay, so first off, I just finished up this book called The Firm Divided, and a lot of what I'm going to be talking about here is based on things from that book. So in that book, it's more generally about corporate governance and how the corporate governance scene works. People like you and I, we're not executives, we're not board members. We don't really know how this stuff works so much. So this was a good introduction to that. Beginner friendly, so I encourage you to check it out at your library or pick it up. So a few key takeaways from this book. Management teams are generally very, very much in power within companies, even more so than you might realize. They control the board a lot of the time, and they're very hard to control. The borderline between illegal versus unethical activities is very narrow. And in this book, there are numerous examples of CEOs taking out funds from the corporate coffers to use for their personal art collections or other things. And while it's not necessarily illegal, it is highly unethical. And how we can, as shareholders, boards of governance, boards of directors in companies, keep track of management and how they operate. And then lastly, most importantly, just really hammering in that incentives are the most important part about corporate governance. If you have a CEO that's incentivized improperly or overcompensated, things will change. If you have a CEO that's been paid so much over time, he doesn't really care about what he gets paid in the future. He doesn't care about his future performance. You're not going to get a very good outcome. And same for the board. Okay, so in particular, what I took away from this in terms of action steps was paying attention to activist investors and the way they operate. Because if we look here, it's important to keep the management team in check. And the people who do that generally when it gets way out of line are activist investors. So this is, broadly speaking, the activist playbook, is they notice a poorly governed company that is undervalued. They'll buy shares in that company. They'll ask the management team and board of the directors to change things more behind the scenes so that the public isn't noticing yet and trying to use their leverage there. And then once the management team, if they don't agree to the terms, the activists, they will go public with their complaints against the company and really humiliate them, I would say is a good way of putting it. They're basically going to say they were incompetent at their job, they are negligent, they're value destructive, and go as far as you can in insulting somebody's performance. And it's pretty nasty stuff. And then next, they're going to file a non-management proxy to remove the old board of directors and put a new board in. This is going to be an important part when we are looking for new investments, because we're going to look for non-management proxies and see if we can get any information on those companies that they're being filed against. Okay, and then after they win the proxy, they're going to make board changes, win the board vote. They're going to make board changes, fire the CEO, etc., take cash out of the company, add debt, whatever. And then they're going to sell shares and profit once the governance of the company has been restored. So here are a few stats about activist investors. Surprisingly, a large portion of activist investors target very small companies. So you might think that a lot of the big hedge fund guys are only focused on large cap stocks. This is actually an area in which the largest investors spend a lot of time on small companies because they have the ability to impact change, to cause change, be a catalyst for change, and really make their investment shorter term in nature because they will be providing that catalyst. And a lot of times, smaller companies, they have fragmented and then concentrated ownership in the management team, and it can be a fiasco. So you can see here there are a number of activist targets. This is worldwide, but a number of these are in the United States every year, and it's been trending upwards decade over decade. I think we're at a pretty large increase, so it's definitely something you want to keep an eye on. There are numerous examples of activist targets being massively value accretive to private investors like you and I. So how can the little guy profit from all this? How can me or you or I make money off of this? How do we pay attention to these activist investors and know what to do? That's going to be part 2. So in order to profit from activist investing situations, we have to know where they're operating and what companies they are looking to get involved with and make change in. So I'm here on this website. If you just look up 13D filings, that is the activist investor form that they have to submit with the SEC. That states that they own over 5% of a company, and they're indicating the D stands for they're looking to make a change or influence management in some way. If you see a G, that means they're intending to be a passive holder and not really talk to management and change things up all that much. So when you go on the site, you're going to look for 13D, and then also if it's green, that means they added to their stake and they've increased their share ownership. If it's red, that means they are decreasing their share ownership, and it's probably not a great time to be going in. So I pay more attention to the D, green ones, and just go from there. So you can take a look at some of these, maybe spend some time filtering through just to see what's going on. Maybe look up the companies and see what they do. That's what I've done. You need to go pretty quick since there are quite a few of these filings. But the good ones and the ones you want to pay attention to, they'll sort of stand out more as like, okay, this is something I need to pay attention to. This is the first resource. The second resource is you just look up this. This is the non-management proxy form for the SEC, and you just sort of scroll down here to this one, and you click on it, and it'll just bring up every single non-management proxy, which is essentially a voting ballot for the annual meeting where they vote in the board of directors, other corporate governance things, etc. And here we can see the companies and the funds that are filing DFAN 14As, non-management proxies. This is an interesting one. I thought it had a presentation. Sorry about that. But we're going to be taking a look at this one more in depth. CMCT, I have it pulled up here. CIM Commercial Trust Corporation. So this is a real estate investment trust. I just found this searching through filings. It's a pretty interesting story. I thought it was going to be a lot more interesting at first until something recently happened. So just as some background here, there was an activist investor that basically said, okay, we've acquired this much of the company. You need a change. And what was going on in the company was it's an externally managed real estate investment trust. So that means that people outside of the company management, so there's like a property management company that manages the property, and they get paid on a percentage of net asset value. Percentage of net asset value really has nothing to do with market cap. And so you could come to the conclusion that this market cap could be severely depressed and the management team is still getting compensated very heavily. And that's exactly what is happening. The management, the external managers of this real estate investment trust, primarily office, so it's gotten killed too over the COVID times, has basically been raping the company of their profits for the fees of management. And it's kind of a problem. So the external investors filed their form. They said, hey, we want to enact change on the board. We want a complete overhaul of the board. We want a new management team put in. It's going to save the shareholders 70 cents, I think, at least per share per year. And that's pretty significant when you look at the market cap of the company is less than 11. So, that would be very significant in terms of earnings, funds from operation, whatever metric you want to use. Then this is what happened next. The management team, which is the directors are the managers of this external management company, strangely enough, they decided we're going to just try and dilute the activists and dilute our shareholders by holding a rights offering. And you'd think, oh, why would you hold a rights offering at like 25% of NAV? Because their net asset value, or it's not exactly 25%, but their net asset value is well over $20 per share, according to them. So they're holding a rights offering at $9.25. So they're essentially diluting their net asset value per share in order to prevent the activists. So what they're going to do is they're going to hold this rights offering. Not everybody's going to participate. This external management company that owns a lot of the stock is going to backstop it. They're going to get more shares at $9.25, less than the market price and well below NAV, and they're going to have enough shares to nullify the activist investor takeover attempt. So I was interested by that until that happened, which basically made me quite cautious. And this is going to be a situation that we're going to want to monitor over the coming months. We're going to want to see, where is that here? We're going to want to just pay attention to the non-management materials that come out. If the activist investors that are targeting this company start to sell shares, we're going to not want to get in. But if they continue to buy shares and if they participate in the rights offering fully and even oversubscribe to their rights, I think we're going to be able to maybe make some money here, but I'm just not sure yet, really, because what could happen is the current management team gets enough shares from the rights offering, they dilute everybody else, and they can keep their own board in place and continue to rape funds from the company. So this is just one example. It's pretty interesting stuff. You can read materials like a presentation. I don't know if I could find one here. No, I can't. Where activist investors totally call out management teams as being pretty much evil and incompetent. And if you're into drama, if you're a financial nerd, you might find it interesting. So thanks for watching. Tell me what you think. I'm not in love with this video. I didn't really enjoy it. But just felt like making a video. So thanks, bye.